As much as I love Nvidia, I'm thrilled that we can finally return to a market where there are many important stocks representing many important trends instead of one stock that's captured the attention of legions of investors, many of whom have no idea what it does, let alone where it fits into the technological food chain. I stand by view that you should own the stock of Nvidia and not trade it. After all, I've spent days warning you that the buy-side expectations were too high and the stock had run way too much going into the quarter. I told you the company needed to deliver a gargantuan beat and raise quarter in order to make it rally, something that seemed very unlikely, if not downright impossible. But I never backed away from my belief in the value, the ultimate value of the company. What I'm saying is that in the end, Nvidia isn't a concept. It's not a cult. It's not a miracle. It's a company that designs really fast chips that allow for rapid calculations that help companies speed up the solving of problems while improving productivity. You can't ask Nvidia's Blackwell chip to cure cancer. You can't do that. It won't put a man on Mars. It certainly can't bring about world peace. Yet when you look at how this stock was trading in recent weeks, the market was basically asking CEO Jensen Huang to do all of these things and more. Instead, right now, it looks like it can expand customer gross margins. Important, but not earth-shaking, especially because the enterprise is the client, not you. You won't even see it. Now that this quarter's in the rearview mirror, my hope is that those who wagered on the stock, notice who were wagered as opposed to invested in the company, will finally move on. No more exact a box with AMD to place, please.
Jim Cramer is discussing Nvidia's latest earnings report and the market's response to it. Despite delivering a strong quarter, Nvidia didn't meet the sky-high expectations set by investors and money managers. Many had expected Nvidia to outperform in an extraordinary way, given its track record. Cramer highlights that while the company is still solid, the market has built unrealistic expectations around Nvidia, which could not be sustained. This recent earnings report brought Nvidia back to a more normal trading environment, and Cramer hopes that this will lead to more realistic stock valuations moving forward. Cramer is relieved that Nvidia is no longer viewed as a miracle maker by investors, but simply as a highly successful company that makes powerful chips, particularly for AI and data processing. He stresses that the company should be evaluated like any other stock, based on tangible earnings and reasonable price-to-earnings ratios. Nvidia's potential future growth should continue to warrant a premium valuation compared to the average stock, but the extreme hype surrounding it is no longer justified. Cramer encourages a return to rational investing, as opposed to the speculative mania that Nvidia's stock previously experienced. Looking ahead, Cramer suggests that this shift in market sentiment toward Nvidia opens the door for attention on other high-quality companies such as AMD, Apple, Amazon, and Salesforce. Each of these companies presents its own strengths, from AI applications to retail success, and deserves focus in a more balanced market. Cramer believes this change is healthy for the market, enabling investors to better appreciate a range of companies beyond just Nvidia, and value them based on fundamentals rather than excessive hype.
After this news, if I put my life savings on Nvidia, don't blame me. Turns out Nvidia's mortal after all. Even though it reported a great quarter last night, it wasn't able to deliver its key product fast enough to allow the company to do what it's done so many times before, blow away the earnings. Yeah, raise its forecast to unfathomable levels. Nvidia didn't define today's trading because it failed to dazzle in the way that so many money managers have come to expect. It didn't even seem to matter to the averages though. Dow advancing 244 points, S&P basically 5, Nasdaq dipping just 0.23%. My response to all this, all I can say is, goodness gracious. With this quarter's results, the albatross of perfection is now gone, the millstone shredded. How about a company like Apple, which is about to issue a new phone that will soon be offering the latest in artificial intelligence for the consumer? The stock's historically pricey, but historically Apple didn't have a service revenue stream that's sticky and predictable. It creates a whole new level of stable earnings. Plus, Apple will be using ChatGPT, which has cost OpenAI and Microsoft billions of dollars to build, yet these guys are getting it for free because Apple's such a huge, highly valued installed base. Hey, how about Amazon? Stock down 29% off its top, like 29 points, not percent, 29 points. Even as we've just seen some surprisingly strong numbers from a series of major retailers, Best Buy this very morning, Walmart and Target. The consumer's clearly doing fine as long as you give her good value. And that's Amazon's middle name. Plus, they've got the best beat on how to use AI to figure out your buying patterns and batch your orders for same-day delivery. Something that only costs Costco and Walmart. They're the only ones that can possibly beat them when it comes to price, but not delivery. Maybe Walmart Plus will deliver. on a company like Salesforce. How about this? Salesforce, they reported last night, they know how to use a generative AI to create smart agents that can answer pedestrian questions. Very important, because pedestrian questions are about 90% of what customer service reps need to handle. Agent Force, the new AI initiative, will allow for massive expansion of gross margins, as bots are a lot cheaper than people. We'll learn more at the company's annual Dreamforce Festival in 3 weeks. Again, not a barber, but that's the point of artificial intelligence. AI doesn't burn barns. It simply imitates us, which can be pretty valuable if you run a business. That stock should have been up, not down today, because the use cases were so compelling. I don't know what happened. It was a mistake to me. So I say goodbye to the Nvidia watch parties. Let's go back to the days when Jensen Huang was seen as a brilliant engineer with a black leather jacket and lots of amazing ideas, not an otherworldly miracle worker. Nvidia is not the hope for the future of mankind. It's a company that's very, very good at what it does. It's leading the AI revolution, which doesn't cure cancer or even the common cold. It does help businesses do things quicker and for less money than ever thought possible. Bottom line, Nvidia is not Legion, not Superman, just an excellent computer company led by a CEO who's one of the best at what he does. Just remember though, even with Nvidia, it's not personal. It's strictly business. Back to a world where we try to value Nvidia like any other company. We have to put a reasonable price to earnings multiple, PE multiple on it, given its growth rate. Wall Street analysts are saying Nvidia can earn $5 per share in 2026, which I think is a reasonable time frame when you're evaluating a big growth stock. We have to figure out what it should be worth based on that dollar number. Given that Nvidia is growing much faster than the average company, it deserves to trade at a premium to the benchmark S&P 500, right? You with me? That currently sells for roughly 24 times this year's numbers. Since we're using the 2026 estimates from Nvidia, the results in a little more of a discount. So let's say 24 times $5 of future earnings per share. What does that give you? $120. It's just a few bucks above where it's currently trading. That's trading like the average stock. Now, I could easily argue that Nvidia deserves to trade at a premium to the average stock, the S&P, since it grows much faster than the average stock, and it's a much better company. So let's give it twice the P to E, twice the price to earnings multiple of the S&P. That would put it at $240. Again, whoa, it's not the average company. That seems pretty high, though. So let's split the difference and say that it deserves to trade at 36 times the 2026 estimate. That takes us to up 108, but more than $60 above where it's traded. But realistic. I'm going through this entire exercise of boredom because after this quarter, I'm hoping Nvidia becomes just another company. Maybe even a boring one. One that's valued based on earnings rather than intangibles. And this is how we value a typical high-quality growth stock, which it is. I just gave you the process behind where a stock trades, all stocks. Now, all stocks, including Nvidia. It is a tedious process, this valuing of a stock. But in the end, that's what Nvidia is. It's a stock. Doesn't matter how brilliant Jensen Huang might be. I call him Da Vinci, but it doesn't matter. He's the CEO of a public company, not a magician or an alchemist or an artist. Now, I'm thrilled that Nvidia brought a whole new set of enthusiasts into the stock market, but I'm bummed that so many of these people are more gamblers than investors. They only got in because the valuations went from $500 billion to $3 trillion in 18 months. Therefore, they desperately needed that progression to continue. They were unrealistic, and I sense they now go and be unrealistic, betting on games of sports or chance. DraftKings, here we come. You know what? As Thomas Paine mold, they were always sunshine soldiers. They were always summer patriots and soldiers. I am disappointed. I'm disappointed in these people because I want them to stay, but I sense from the action at the end of the day, they're gone. Summer soldiers. I think this situation makes room for something great though. I want to turn it into, as we'll talk about later in the show, lemonade. Let's turn to lemons and lemonade. See, we can focus now on all the terrific companies that were lost in the Nvidia shuffle. For example, how about AMD, which also makes chips, including chips for that, while not quite as useful for artificial intelligence videos, are still basically in the same league. Plus, AMD makes chips for traditional computing and servers that compete against a hobbled Intel. AMD stock is actually very cheap on its 2026 earnings estimates versus stocks. The others in the S&P. Oh, and by the way, what happened to Nvidia was actually good, not bad for AMD. They are a competitor, for heaven's sakes.
Jim Cramer concludes that while Nvidia remains a highly successful and innovative company, the market's inflated expectations had become unrealistic. The company's latest earnings report brought a sense of normalcy, reminding investors that Nvidia, though a leader in AI and chip technology, should be valued based on its tangible performance rather than overblown projections. Cramer emphasizes that Nvidia's future growth prospects remain strong, but the stock should be approached with a rational, long-term perspective rather than speculative fervor. This shift in sentiment also allows investors to refocus on other high-quality companies, such as AMD, Apple, Amazon, and Salesforce, that have been overshadowed by Nvidia's dominance in the market. These companies offer strong growth potential and deserve attention as part of a diversified investment strategy. Cramer hopes this transition will lead to a more balanced market where stocks are valued based on fundamentals rather than hype. Do you think the market's expectations for Nvidia were too high, and how do you think this impacts its future stock performance? With attention shifting away from Nvidia, which other companies do you believe deserve more focus and why?